It's the summer of 1989, and a young Jordan Belfort is standing inside a cramped brokerage office in Long Island, surrounded by outdated computers and men who look more tired than ambitious, when he makes a phone call that quietly changes his life. He isn't pitching Apple or IBM or any famous company. He's selling a tiny stock worth just a few cents. The client agrees. The deal closes. Belfort looks down at his commission slip and realizes he just made more money from one worthless stock than he did in months selling real investments. In that moment, something dangerous becomes obvious to him. Wall Street isn't ruled by intelligence, it's ruled by persuasion, and persuasion doesn't care about value. By 1991, Belfort and his partner Danny Porish opened Stratton Oakmont, a firm that sounds old and respectable but operates like a pressure cooker. The office is loud, aggressive, and theatrical. New hires aren't taught how markets work, they're taught how people work, how to interrupt, how to create urgency, how to sound certain even when they're lying. Their target isn't professional traders, it's everyday investors who believe they're smart enough to spot opportunity early. Stratton Oakmont doesn't search for good companies, it manufactures them. Penny stocks in the early 1990s are lightly regulated, meaning companies with no revenue, no products, sometimes no real business at all, can still be publicly traded. All they need is a ticker symbol. Stratton buys massive amounts of these stocks for almost nothing, then unleashes the phones. Thousands of calls flood the country every single day, each one telling a similar story about secret mergers, breakthrough technologies, or once-in-a-lifetime chances. The clients feel special because the opportunity feels exclusive. They feel smart because they're early. As more people buy, the price rises, not because the company improves, but because Stratton controls the demand. The excitement feeds itself. Clients check their accounts and see green numbers. Confidence grows, trust deepens. But behind the scenes, the firm is quietly selling its own shares into that demand. By the time the clients realize something is wrong, the price collapses and the phones go silent. By 1993, Stratton Oakmont employs over 1,000 brokers and generates more than $1 million a week. Ferraris line the parking lot, yachts sit in the harbor, office parties happen during trading hours. This isn't hidden behavior, it's celebrated. Success is measured only by money, never by method. And here's the unsettling part. Many victims aren't beginners. They're doctors, business owners, professionals who believe they can't be fooled. That belief is exactly what makes the scam work. The pitch doesn't appeal to greed, it appeals to ego. By 1996, regulators begin circling, not because the fraud is new, but because it's become too large and too loud to ignore. Complaints pile up, patterns become obvious. In 1998, Belfort is arrested on charges of securities fraud and money laundering. Facing decades in prison, he cooperates, gives up names, and watches the empire collapse. In 2003, he's sentenced to 4 years and serves less than 2, and then something strange happens. He doesn't disappear, he reinvents himself. The man who once sold worthless stocks now sells motivation, sales training, and personal transformation. Different product, same skill. Which raises an uncomfortable question. If the system truly punished fraud, why does it still reward the performance that made the fraud possible? The Wolf of Wall Street scam wasn't just about illegal trades in the 1990s. It was a demonstration of how easily confidence can overpower truth, how markets can be manipulated when storytelling replaces substance. Today, the phones are gone, but the scripts remain. The boiler room has moved online. The pressure now comes from social feeds, viral posts, and influencers promising early access. The language has changed, but the mechanism hasn't. Create urgency, control attention, exit before the crowd understands what happened. And just like back then, the real danger isn't ignorance, it's trust and confidence without proof. So the next time you see an opportunity rising fast, ask yourself one quiet question that hasn't changed since 1989. Who's buying and who's already selling? Because when the excitement is loudest, the exit is usually already in motion. Now here's where the story quietly turns back toward you. Because if Jordan Belfort were starting today, he wouldn't need a boiler room, cold calls, or 1,000 brokers shouting into phones. He'd need a smartphone, a following, and a story that spreads faster than doubt. The modern version of Stratton Oakmont doesn't ring your house, it lives in your feed. It uses charts instead of scripts and community instead of commissions. The promise sounds familiar. Early access, asymmetric upside, once in a cycle opportunity, but the psychology is identical. A small group gets in first, not because they understand more, but because they arrived earlier. Price rises, screens turn green, confidence turns into conviction, and conviction turns into silence when the exits begin. What makes this uncomfortable is that nothing illegal has to happen anymore. No fake company, no insider lie, just timing, narrative, and attention, which means the line between a scam and a strategy has become harder to see. So here's the thought worth sitting with. If persuasion can move prices more powerfully than fundamentals, then what actually sets value in modern markets? Is it revenue and cash flow, or belief at scale? And if belief is enough, at what point does speculation quietly become exploitation? Jordan Belfort was punished for manipulating markets with lies, but today markets are moved every day by stories that are technically true and practically misleading. So the real question isn't whether another Wolf of Wall Street will appear. The question is whether we would even recognize him if he did, or whether we'd call him something softer, something safer, something like a visionary.